Welcome back to the deep dive. I want you to look at the calendar for a second. It is February 27, 2026.
A very specific date to start on.
It is, yeah. Because if we were having this conversation 5 years ago, or even just 3 years ago, what we are about to talk about would have been classified as complete science fiction. Or, I guess maybe more cynically, as vaporware.
Oh, absolutely. PowerPoint slides and empty promises.
Exactly. We have been promised the Jetsons' future for decades now, flying cars, commuting through the clouds. And for 50 years, that has been a running joke. But today, literally right now as we speak, that concept has moved from a drawing on a napkin to a bookable service in Dubai.
It really is a watershed moment for the industry. We are looking at the transition from theoretical physics to operational logistics. And as we're going to see, that is a messy, expensive, and just fascinating transition.
And sitting right at the center of that mess is a company called Joby Aviation, ticker symbol JOBY. Now, looking at the screens today, the stock is trading at $10.23.
Which is a really interesting number.
It is, because that price point represents a massive amount of tension in the market. On one side, you have the believers. They see this as the Uber of the skies. They see a stock that should be trading at $55, $60, maybe even higher. They see a $1 trillion disruption of how humans move around cities.
And then on the other side.
On the other side, you have the skeptics, and they are very loud. They see a $6 stock at best that is being propped up by hype, burning cash like a furnace, and facing a mountain of regulatory red tape that would make a seasoned bureaucrat cry.
That is the central question we are tackling today for you. Is this the next Tesla? A company that defines a generation of transport? Or is it a high-tech science project that runs out of money before it ever really takes off?
To answer that, we can't just look at the stock chart. We have to look at the business of mobility. We are going to look under the hood, or I guess under the rotors, of a company that is trying to do something audaciously difficult. Because they aren't just trying to build a plane.
No, if only it were that simple.
They are trying to be Ford, meaning they manufacture the vehicle from scratch. They are trying to be Uber, meaning they run the dispatch network and the app. And they are trying to be Delta, meaning they operate the airline, hire the pilots, and manage the safety. All of that at once.
It is what we call a full-stack approach in the industry, and it is incredibly capital-intensive. By the end of this deep dive, I think you're going to understand why we classify Joby currently as a wonderful company in terms of tech, but why the jury is still out on whether it's a wonderful business in the classic Warren Buffett sense.
And we're going to talk about why a certain Japanese car manufacturer might be the absolute deciding factor in whether they survive.
Right, the Toyota Edge. It is the most important piece of the puzzle here.
Let's get into it.
So good.
Part 1, Chapters 1 to 3, Business, Management, and Financials.
Let's start with the foundation.
Chapter 1, Business Understanding.
So to really grasp what Joby is doing, we have to contrast it with the traditional aerospace model.
Right, because if you look at the legacy model, take Boeing, for example. Boeing doesn't actually make every part of the plane, do they?
God, no. The legacy aerospace model is what we call fragmented integration. Boeing designs the hull and does the final assembly. But GE or Rolls-Royce makes the engines, Honeywell makes the avionics, Spirit AeroSystems makes the fuselage. There are literally thousands of vendors. Boeing is essentially a massive project manager.
And then they sell that assembled plane to United or Delta.
Exactly. And once they sell it, the core financial relationship effectively ends. Aside from some ongoing service and parts contracts, Delta is the one who has to worry about filling the seats, buying the jet fuel, and dealing with the angry customers. Everyone stays strictly in their lane.
But Joby looked at that established model and basically said, no thanks.
They did. They took a page straight out of the early Tesla playbook. They embraced total vertical integration.
What does that actually look like in practice for an aviation company?
It means they control the entire stack. They design the aircraft. They manufacture the components themselves, including the incredibly complex electric motors and the carbon fiber airframe. But here is the kicker. They intend to operate the service themselves. They aren't selling these electric planes to United Airlines. Joby is the airline.
I have to play devil's advocate here for a second. That sounds like an insane amount of operational risk. Manufacturing aerospace-grade vehicles is notoriously hard. Running a commercial airline is brutally hard. Why try to do both? Why not just sell the planes and let someone else deal with the nightmare of flight logistics?
It comes down to one fundamental metric: margin capture.
Follow the money.
Always. Think about it. If you sell a plane, You get a one-time pop on the income statement. You sell it for $5 million, maybe you make $1 million in profit, that's it. But if you operate the network, you capture the recurring passenger revenue. Every single time a person pays $100 for a seat, that goes to you. And you collect that for the entire 20-year lifespan of that aircraft.
So they want the manufacturing margin and the per seat mile recurring revenue.
They want the whole pie.
Yeah.
But it also allows for much tighter feedback loops. If a specific part keeps wearing out early, they don't have to call a vendor in Germany and negotiate a redesign contract. They just walk down to the factory floor and fix it. That speed of iteration is critical when you are inventing an entirely new category of vehicle.
Okay, so that's the philosophy behind the business. But philosophy is worthless if the machine itself doesn't work. Let's talk about the hardware, the S4 aircraft.
This is their crown jewel.
We are looking at a 5-seat vehicle, 1 pilot, 4 paying passengers. It has a top speed of 200 miles per hour and a range of about 100 miles on a single charge. But when I look at the analyst reports we gathered for this deep dive, nobody is obsessing over the speed or the range. Everyone is obsessing over the sound.
Yes, the acoustic profile. This is the single most important metric for the entire industry.
Why is that? Why does the sound matter more than how fast it goes?
Because of where this thing needs to operate to be profitable. The biggest barrier to urban aviation has never been flight physics. I mean, we've had helicopters for decades. The barrier is that cities absolutely hate helicopters.
Because they're loud. They rattle the windows of skyscrapers.
They are incredibly aggressive acoustically. A traditional helicopter relies on what we call blade slap. The tip of the main rotor is moving near the speed of sound, creating these massive pressure waves. If you try to land a helicopter in downtown Manhattan or a quiet suburb in Los Angeles every 5 minutes, the neighbors will sue you into oblivion. The city will step in and revoke your zoning permit instantly.
So how does Joby solve the blade slap problem?
Through distributed electric propulsion, the S4 has 6 separate rotors. Because the thrust is distributed across 6 hubs, they can spin much, much slower than a single massive helicopter rotor. Lower RPM means lower tip speed. Lower tip speed means you eliminate that sonic blade slap entirely.
I saw a comparison in the research that honestly blew my mind. They said it's as quiet as a household refrigerator.
That is the analogy they use for when it's in overflight, meaning when it's cruising about 1,000 feet up. It's putting out about 45 decibels. That is basically a hum. It blends completely into the background noise of a city. You wouldn't even look up if it flew over your house.
And what about when it lands? Obviously, that has to be louder when it's right near the ground.
It is, but surprisingly not by much. At hover, it's around 65 decibels. That is the volume of a normal human conversation. Compare that to a helicopter, which is routinely over 100 decibels. And remember, the decibel scale is logarithmic, so 100 is exponentially louder than 65. It's 100 times louder.
So the working theory is, if it's quiet, the local municipalities will actually let them build landing pads.
Precisely. The acoustic profile is the master key that unlocks urban real estate. It turns the sky above populated areas into usable infrastructure because you aren't annoying the voters on the ground.
Okay, so we have a quiet plane. Now let's talk about the user experience. Because you mentioned earlier they want to be Uber. And, well, they literally bought the software from Uber.
Right. Back in 2021, they acquired a software suite called Elevate OS directly from Uber. This serves as their digital backbone, and it enables a concept called multimodal trip stitching.
Trip stitching? That sounds like something my grandmother does on Sundays.
It is a bit more high-tech than that. It's all about removing friction for the user. Think about the friction of flying commercially today. You take a cab to the airport, you pay the cab, you wait, you fly, you find another cab at the destination. It's incredibly disjointed.
It's a massive hassle.
Elevate OS integrates all of that into a single ecosystem. You open the app, you type in Wall Street to JFK Airport. The app automatically books an Uber car to pick you up at your door. It coordinates your arrival at the vertiport with the exact Joby flight schedule. It generates a single digital ticket, and it automatically has another Uber waiting for you at the terminal when you land. One tap, 3 legs of the journey stitched together. Single upfront price.
That level of seamlessness is exactly what they need to compete. Because if I have to juggle 3 different transit apps, I'm just going to book a black car and sit in traffic.
Exactly. In the transportation business, friction is the absolute enemy of adoption. If it isn't ridiculously easy, people just won't change their habits.
So we have the revolutionary plane, we have the slick app, now we run into the hard part. The part that killed DeLorean, the part that almost killed Tesla in 2018. manufacture.
Manufacturing wall.
Building one gorgeous prototype is an engineering challenge. Building 500 identical, perfect aircraft a year is a logistics nightmare. Where do they stand on that front?
Right now, it's a boutique operation. They are in pilot production at their facility in Marina, California. They are currently churning out roughly one aircraft per month.
One a month. That does not sound like a global transportation revolution.
It's not. It's a craft shop right now.
Yeah.
But Marina is really just the laboratory. It's where they are figuring out exactly how to build it efficiently. The real volume play is happening in Dayton, Ohio.
Dayton, the birthplace of aviation. The Wright brothers.
Yeah, it's a very nice bit of poetry there for the PR team. But practically speaking, it's about access to skilled manufacturing labor and massive physical space. They acquired a facility there that is 728,000 square feet. The goal is to ramp up to 4 aircraft a month by 2027 and eventually hit an ultimate capacity of 500 aircraft per year out of that plant.
500 a year actually creates a real viable fleet.
It does, but we have to be realistic about the timeline here. Going from one hand-built unit a month to 40 mass-produced units a month is exponentially difficult. This is where that Toyota partnership we tease becomes absolutely vital. Toyota engineers are practically living in that factory, teaching them how to scale without losing quality.
We will dig much deeper into Toyota in part 2. But before we move to management, I need to do a reality check on the money. I saw a headline, maybe you saw it too, that their revenue was up something insane like 55,000% year over year in Q4 2025.
I did see that headline making the rounds.
That sounds incredible on the surface. It sounds like they are already printing money. Is that a real number?
It is technically a real accounting number, but it is contextually very misleading for an investor.
Break that down for me.
They reported $30.8 million in revenue for Q4 2025. But you have to ask yourself, where did that cash actually come from? It didn't come from flying you or me in an electric air taxi.
Because those aren't running yet, so where is it coming from?
It's inorganic revenue. Joby acquired a company called Blade Air Mobility. Blade flies traditional fossil fuel helicopters. They sell seats on noisy, gas-guzzling choppers right now. So when you see that massive revenue spike, you are mostly seeing ticket sales for conventional helicopter rides. You're also seeing some research and development contracts they have with the Department of Defense.
So the massive percentage jump is really just an accounting artifact? It's because they bought a company that was already generating cash?
Correct. It's a financial bridge. They are using that legacy helicopter revenue to keep the lights on and build infrastructure while they wait for the electric S4 planes to be fully certified. They are guiding for maybe $115 million in revenue for 2026, but again, the vast majority of that is just the legacy helicopter business. The real Joby revenue, the electric revolution revenue, won't start trickling in until late 2026, starting with that big Dubai launch.
So the takeaway is, don't let the flashy headline fool you. The core electric business is still very much in the womb.
Exactly. We are squarely in the investment phase, not the harvest phase.
Chapter 2, Management Evaluation.
So let's pivot to the people actually running this show. You can have the best plane in the world, but if the management team can't execute the vision, the stock is worthless. The guy at the top is Joe Ben Bevirt. What is his story?
Well, Joe Ben is a genuinely fascinating character. He isn't your typical slick Wall Street CEO in a bespoke suit trying to pump the stock. He's a deep technologist. He's a serial entrepreneur. He founded a company called Velocity 11, which did advanced robotics, and he actually founded Joby Inc., specifically to solve this electric flight problem.
I have heard him compared to some pretty heavy hitters in the tech hardware world.
The most apt comparison I've seen in the research is to Lisa Su over at AMD. If you remember, before Lisa Su took over, AMD was flashy but structurally failing. She came in as a hardcore engineer and turned it around not with marketing campaigns, but by relentlessly focusing on the silicon, getting the little pieces right. Jobin has that exact same vibe. He is obsessed with the product. He's more often found on the factory floor than in the boardroom.
But it hasn't all been smooth sailing for him or the team. Being an engineer means you naturally push boundaries, and sometimes those boundaries push back hard. We have to address the elephant in the room. The 2022 crash.
Yes, we do. This is a critical case study in how this specific management team handles a real crisis. Back in February 2022, they were pushing a prototype to its absolute limits. They were doing high-speed testing well beyond what a normal passenger flight would ever entail.
And what exactly happened up there?
A propeller blade physically separated from the aircraft. The physics at those extreme speeds are just unforgiving. The aircraft lost control and went down. It was a total, whole loss. Thankfully, it was remotely piloted, so no one was hurt.
That sounds like an absolute nightmare scenario for an aviation startup. That is the kind of event that can bankrupt a pre-revenue company if they handle the PR and the regulators poorly.
It is, but their response was textbook safety culture. They didn't try to hide it or bury the data. They didn't spin it to the press. They immediately and voluntarily paused all flight testing across the board. They invited the NTSB in and gave them full, transparent cooperation. And most importantly, they used that failure to fundamentally redesign the propeller mechanism and the flight control systems.
And the subsequent data suggests that mindset stuck, right? It wasn't just corporate lip service.
It absolutely stuck. If you look at their internal safety reports for 2024, despite growing their overall workforce by 11% and massively ramping up the volume of testing, their total recordable incident rate, or TRIR, actually dropped by 34%. That tells me they didn't just fix the broken prop, they fixed the underlying process. They proved to the FAA that they prioritize safety over speed.
Now let's talk about how they handle the financials. Because building a vertically integrated airline from scratch is violently expensive. They openly call their strategy the fortress balance sheet.
And for very good reason. Just this month, in February 2026, they went out and raised another $1.2 billion. That was a mix of selling fresh equity and issuing convertible notes.
I want to zoom in on those convertible notes for a second because you flagged them in our pre-show notes as a stroke of financial genius.
They really are brilliant. A convertible note is basically corporate debt that can magically turn into stock later on. But the terms they negotiated here are incredible. These notes mature in 2032, so they have 6 full years before they even have to worry about paying the principal back. And the coupon, which is the interest rate they pay annually, is only 0.75%.
0.75%. In this macro economy, interest rates are way, way higher than that globally. That is basically free money.
It is incredibly cheap capital. It shows that institutional investors trust them enough to lend them a massive amount of money for almost nothing, betting that the stock price will be significantly higher in 2032 when it converts. It effectively locks in their cash runway for the long haul.
But if we look at their return on invested capital right now, their ROIC, it is just ugly. Negative 37% to negative 64%.
It is ugly on paper, but you have to view that as the price of admission. You cannot create a brand new heavy manufacturing industry and expect to be profitable in year 1 or even year 5. They are intentionally burning cash to build massive defensible assets. The factory in Dayton, the FAA certification, the proprietary IP. If you are a traditional value investor looking for immediate quarterly dividends, this stock is absolutely not for you. This is a long-term capital allocation play for a decade down the road.
Chapter 3, Financial Health.
That leads us perfectly into the raw financials. We know they have raised a ton of cash, but they are also spending it like crazy to build these factories. Let's look at the burn versus the cushion.
Right, so looking at the full year 2025, they burned through somewhere between $540 million and $563 million. That is just core operating costs, keeping the lights on, paying the aerospace engineers, running the wind tunnel tests.
That is over $500 million out the door in 12 months. That's a startling number for a company with virtually no product revenue.
It is a massive burn rate. But thanks to that recent $1.2 billion raise we just discussed, their total liquidity cushion post-raise is approximately $2.6 billion.
So if they're burning roughly $500 million a year and they have $2.6 billion sitting in the bank, back of the napkin math says they have about 5 years of solid runway.
Roughly, yes. And in this sector, that is massive. In the deep tech startup world, time is your most valuable resource. That $2.6 billion means they can comfortably survive the valley of death. That perilous period between certifying the aircraft and actually scaling up to make a profit. Even if the FAA delays them by a year, even if the manufacturing ramp is slow, they have the cash to outlast their underfunded competitors.
Let's talk about how the market values all of this. The market cap is hovering around $9.4 billion right now, but the price-to-sales ratio is, well, it's astronomical, over 180 times sales.
It is a stretched valuation by any traditional metric you want to use. A standard, mature industrial company might trade at 2 times or maybe 5 times sales. Joby is at 180. But you have to understand the psychology here. Investors aren't paying for the $50 million in legacy helicopter revenue today. They are paying a premium for the potential billions in global eVTOL revenue in 2030.
It's purely a bet on the future state of the world. What about the price-to-book ratio? That compares the stock price to the actual tangible value of their assets on the balance sheet.
That metric is also very high. It's sitting around 10 times book value. For context, the traditional airline industry average is usually around 1.7. This tells us clearly that the market is placing a huge premium on their intangible assets, their intellectual property, their software, their lead and certification progress, and specifically that partnership with Toyota. The market is essentially saying, we believe your proprietary know-how is worth way more than your physical factories are currently worth.
Okay, so the relative valuation against standard companies is high. But what about the intrinsic value? If we actually run the numbers, the discounted cash flow models from the analyst, what is this stock actually worth on paper?
This is where the math gets incredibly tricky, because the risk profile is binary. If the FAA suddenly says, no, you can't fly these over cities, the value of the company is basically zero. Because of that existential risk, the discount rate, or the WACC, used in these models is very high, usually around 18 to 27%,
So that high discount rate heavily pulls the present value down.
drastically. If we look at a bear case scenario, where certification gets delayed by a year or two and they are forced to dilute shareholders again to raise more cash, the model suggests a fair value of $6 to $7. That's a significant downside from today's price.
Well, what about the median case?
The median case, assuming they launch in Dubai on time later this year and hit those manufacturing targets in Dayton, puts the fair value right around $12 to $12.60. That suggests the stock is slightly undervalued today at $10.
And the bull case, the ultimate Uber of the skies dream scenario.
If they execute perfectly and they become the dominant global player, displacing helicopters entirely and taking a big chunk of premium ground transport, the models point to $55 per share. That is the asymmetric bet retail investors are making here. You risk dropping to $6 to potentially make $55.
Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion.
Chapter 4, Market Sentiment.
Welcome to Part 2. We have looked extensively at the company itself. Now let's look at the market. What is the actual mood on Wall Street regarding Joby right now?
I would describe the prevailing mood as polarized optimism. It is a genuine battleground stock. If you look at the professional analysts covering the company, it's a total split down the middle.
Very.
You have 11 major analysts. Some, like Needham, are saying buy with an $18 price target. They see the inflection point coming right now. Others, like JP Morgan, are saying sell with a $7 target. They're hyper-focused on the cash burn and the massive execution risk.
It seems like the retail investors, the regular folks trading on their phones, are feeling a bit more optimistic lately compared to the institutions.
They absolutely are. The major catalyst was February 25, 2026. That was the day the Uber Air bookings for the Dubai launch were officially announced. That completely changed the psychology of the retail market. Suddenly, this wasn't an R&D science project anymore. It was a real service you could pull up and book on your phone.
We saw volume on message boards like StockTwits surge 188% that week. People just love a tangible consumer product.
Exactly. It shifted the retail sentiment from bearish to incredibly bullish almost overnight. When you can literally see the booking button on a screen, the skepticism melts away a little bit.
But if we look at the technicals, the actual lines and moving averages on the chart, it's a bit of a mixed bag, isn't it?
It is very confusing right now. On February 18, 2026, the stock formed what traders call a death cross.
That always sounds so ominous.
It sounds worse than it is, but is definitely not a great sign. It's when the short-term 50-day moving average crosses below the long-term 200-day moving average. It usually signals a sustained long-term downtrend. It means the momentum has been steadily leaking out of the stock for a while.
But there's a counter signal happening at the exact same time, right?
Yes. Just a single day later, the MACD histogram, which measures much shorter-term momentum shifts, actually turned positive. So you have a long-term bearish technical signal violently clashing with a short-term bullish reversal signal. It tells us the stock is at a major decision point. It's winding up like a coiled spring for a big move, one way or the other.
And betting against that upward move is a fairly significant chunk of the market. The short interest is pretty high.
It is. About 11 to 13% of the available public shares are currently sold short. That is roughly 75 million shares betting that the price will go down. These are the hedge funds and traders who still firmly believe it's vaporware, or that the valuation is just completely divorced from reality. Now, if the stock starts to rise rapidly on good news, those shorts might be forced to buy shares to cover their positions, which could heavily fuel a short squeeze.
Chapter 5. Ownership structure.
So who actually owns this company? Because when you look at a highly volatile, futuristic stock like this, you really want to know who is holding the bag in the trenches with you. Are they day traders flipping it, or are they long-term believers?
The registry here is surprisingly stable for such a speculative name. It's heavily dominated by what we call strategic anchors. And the most critical one, without a doubt, is Toyota.
Toyota owns a really big chunk, right?
They own about 13 to 15% of the entire company. But we cannot overstate this point enough. Toyota is not just a passive investor managing a portfolio. They didn't just write a big check and walk away. They currently have 200 of their own seasoned manufacturing engineers physically embedded in Joby's factory.
That is just wild to think about. Legacy Toyota engineers working daily on electric flying cars.
It is the legendary Toyota production system being actively applied to aerospace. Toyota is the undisputed global master of defect-free mass production. Having them in the building is Joby's secret weapon against that manufacturing wall we talked about. It de-risks the production ramp significantly more than any amount of cash could.
Who else is in the top tier of holders?
You have the heavy hitters of long-term growth investing. Bailey Gifford owns over 5%. These are the exact same folks who backed Tesla early and held on through the extreme volatility. You have Vanguard holding a massive passive stake. You even have Delta Airlines with a small strategic stake to secure future routes. The top 10 holders combine control over 50% of the outstanding shares. These are diamond hands. They aren't panic selling because the stock dipped 5% on a random Tuesday.
However, some people inside the house are selling. We have to address the insider transaction activity.
Yes, we do. In the last 90 days, we have seen corporate insiders sell about 1.47 million shares. That creates a lot of negative noise on the message boards.
Specifically, the CEO, Joby Aviation. He personally sold about $5.8 million worth of stock in mid-February. To the average retail investor, that never looks good. It feels like the captain is cashing out before the ship sails.
Optically, it is definitely tough. But again, context is key here. The vast majority of this insider selling is purely for tax obligations or tied to pre-scheduled 10b5-1 plans.
Can you explain that 10b5-1 plan concept for listeners who might not trade a lot?
Sure. It is a legal trading plan you set up months or even years in advance with the SEC that says, sell X amount of my shares on this specific date, regardless of what the stock price is doing. It's explicitly designed to prevent executives from facing insider trading accusations. When huge blocks of stock vest for these founders, they instantly face a massive tax bill from the government. They often have to sell a portion of those shares just to pay the IRS. It does not necessarily mean Joby has lost faith in the company's trajectory. But that being said, when the sheer volume of selling is that high, it inevitably puts downward pressure on the stock price in the open market, which directly contributes to that recent weakness we saw.
Chapter 6. Risk Assessment.
We have been pretty positive on the tech and the cash so far, but we need to look coldly at the dangers. In the research notes, they refer to these as the three walls.
Yes. For Joby to ultimately succeed and justify that valuation, they have to smash through three massive sequential barriers. The first is the regulatory wall.
Getting past the FAA.
The FAA. Joby is currently in the TIA phase. That stands for Type Inspection Authorization. This is basically the final exam for an aircraft. They're now flying for credit. Every single maneuver, every sensor reading on every flight is scrutinized by federal regulators. It is a grueling process. If they fail a specific test, or if the FAA simply decides they need 6 more months of baseline data, that commercial launch timeline easily slides to 2027 or 2028. And as we established, time is money.
What is the second wall?
The manufacturing wall. We touched on this with Toyota. Traditional aerospace is historically bespoke. Every Boeing plane is practically hand-built with incredible scrutiny. Toyota is trying to bring automotive assembly line speed to aviation without sacrificing that safety. If that translation fails, if they find out they can't build these things fast enough without introducing microscopic defects, the entire unit economics model breaks.
And the third wall?
The infrastructure wall. You can build the perfect plane, you can get it fully certified, but you desperately need a place to land it where the customers actually are. Vertiports. Now, Joby has exclusive operating rights in Dubai for 6 years, which is a huge head start. And they have a working deal with a company called Metropolis for 25 initial sites across the U.S. But to truly scale, they need hundreds of these. If local city councils don't approve the zoning, or if the municipal power grids literally can't handle the massive voltage required for rapid charging, the planes stay grounded.
I want to bring in the very specific context of early 2026, because the geopolitical landscape right now is, well, it's incredibly complicated, We have renewed trade wars, we have sleeping tariffs. How does that macro environment impact a hardware company that relies on complex global supply chains?
This is a critical, actively developing story for the stock. Just this month, February 2026, we saw a massive shift in U.S. trade policy. The Supreme Court invalidated some previous localized tariffs, but then the administration immediately invoked Section 122 of the Trade Act.
It's a blanket global tariff.
Right, a flat 10% global tariff on imports. Now here is the massive save for Joby. Civil aircraft parts were explicitly written to be exempt from Section 122.
That is a huge bullet dodged for their procurement team.
It's massive. Joby's electric motors rely heavily on specific rare earth magnets and precision components sourced from Japan and Taiwan. If those raw parts were hit with an unexpected 10% tariff overnight, their projected margins would be crushed before they even launch. That specific exemption saves their unit economics on the propulsion system.
But they didn't get off completely scot-free, did they?
No, they didn't. Raw industrial materials are the real problem now. Raw steel and aluminum imports are subject to Section 232 tariffs, which are not exempt. Those tariffs are still sitting around 50% for many international partners.
So the raw metal frame of the aircraft just got significantly more expensive to produce.
Exactly. Industry analysts estimate frame costs could easily rise 12 to 18% based on this. But honestly, the much bigger threat looming is China.
The threat of direct retaliation.
Yes. China is actively hitting back with aggressive retaliatory tariffs, specifically on raw lithium and rare earth elements. The batteries are the fuel tank of an electric plane. They make up a huge portion of the vehicle's weight and cost. If battery cell costs spike 25% because of an escalating trade war with China, that is a direct, unavoidable hit to Joby's bottom line. That is the kind of macro risk that no amount of brilliant Silicon Valley engineering can solve.
Chapter 7.
Conclusion.
We have covered a massive amount of ground today. We've looked at the acoustic tech, the cash burn, the strategic partners, and the geopolitical risks. Let's bring it all together. Synthesis time.
If we boil this entire complex narrative down, we have a very clear bull versus bear setup. The bull argument says, Joby has already done the impossible. The technology actually works. The FAA seems happy with the progress. Toyota is building the assembly line. The binary risk of failure is rapidly fading. They are the last man standing in a brutally tough industry simply because they have the $2.6 billion in cash to survive.
And the counter-bear argument. The bear argument says, you are looking at a $9 billion valuation based entirely on hope and projections. They are actively diluting retail shareholders by 22% a year to fund this dream. If there's a single battery fire during testing, or if the FAA certification slips another year, the stock plummets to $5. And right now, in the volatile economic environment of early 2026, the broad market hates speculative risk.
So weighing all that, what is the final verdict?
The verdict is that Joby is undeniably the clear, undisputed leader in the eVTOL sector. Based on the median DCF models, fair value right now is probably around $12 or $13. So sitting at $10.23 today, it is technically trading at a discount.
It's on sale.
A highly risky sale, but yes, a sale.
And what's the final outlook for someone looking at this space?
I would frame it like this. Joby Aviation is a wonderful company. The engineering culture is strong, the acoustic tech is real, the strategic partners are world-class. But it is not yet a wonderful business. It still burns far too much cash and has massive ongoing capital needs to reach scale.
It desperately needs to grow into its own ambitious business model.
Exactly. For the long-term investor, you hold this stock because of the Toyota edge in manufacturing and the Uber moat in software, but you have to have a stomach of absolute steel. Expect wild volatility. This trade war environment of 2026 is going to make the daily stock chart look like a roller coaster.
But if you can stomach the turbulence of the ride, the final destination might just be worth it.
I want to leave you with one final thought to mull over. Later this year in Dubai, a normal person is going to pull out their smartphone, tap a button, and a quiet, fully electric aircraft is going to land, pick them up, and fly them right over the gridlocked traffic. In that exact moment, the cynical argument about whether this technology is just vaporware dies forever. It's over.
Yeah.
The only question left for Wall Street will simply be, how fast can they build them?
That is the moment everything changes for mobility.
A huge thank you for listening to this deep dive into Joby Aviation. Just a reminder before we go, this analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.